Financial statements are reports that summarize important financial accounting information about your business. There are three main types of financial statements: the balance sheet, the income statement, and the cash flow statement. To create our financial statements, we are going to be working in the Excel spreadsheet. Before we dive into the financial statements, we first want to go over the accounting equation. The accounting equation is assets minus liabilities equals owner's equity. Assets describe anything of value that a company owns. Assets are typically subcategorized into current assets and long-term assets. Current assets are assets that are typically converted into cash or used within 1 year. For example, inventory, accounts receivable, and supplies. Long-term assets are more permanent and are expected to last long periods of time, such as equipment or property. Liabilities refer to the debts that a company owes, such as bank loans or unpaid bills. Liabilities are also subcategorized into current liabilities, which are those that are due within 1 year, and long-term liabilities. Equity represents the value that belongs to the owner or owners of the company. Owner's equity is calculated by subtracting liabilities from assets. When you total up everything of value that you own and subtract everything that you owe, your equity is what is left over. The balance sheet, also known as the statement of financial position, is a financial statement that shows a snapshot of the financial position of a company at a particular moment in time. It outlines the company's assets, liabilities, and owner's equity. The name balance sheet comes from the fact that each side of the statement should balance, meaning that the total assets on the left should be equivalent to the sum of the liabilities and owner's equity on the right. In order to create your balance sheet in Excel, make sure that you are in the Balance Sheet tab in the Excel spreadsheet. Start by entering the specific date, month, and year that you are creating your balance sheet on. First, you want to identify how much cash you have on hand. If you have a business account, how much money is in there? Now, from your operations plan, you would have identified assets that you purchased, such as equipment and furniture, and also supplies and inventory that we identified earlier on in the course. These can be plugged into your balance sheet under your assets along with their value. Remember that your assets should be categorized into current assets and long-term assets. Current assets are those that will be used up or converted to cash within 1 year, such as supplies, inventory, and accounts receivable, which is money that is owed to you. Long-term assets are those that will be used over a much longer period of time, such as equipment and furniture. Now over to the other side, your liabilities will consist of amounts of money that you owe, such as loans or debts that you have with suppliers, perhaps. And finally, you will then calculate your owner's equity by subtracting your liabilities from your assets. If calculated correctly, you will notice that the sheet should balance. The income statement shows a company's net profit or net loss over a specified period of time. It shows the company's sales, cost of goods sold, and expenses. Remember that cost of goods sold or cost of service are the direct costs related to the goods or services sold. Expenses are costs that a company incurs in the process of doing business. Expenses can include telecommunications expenses, wages, and insurance. On the income statement, gross profit equals revenue minus cost of goods sold. Net income equals gross profit minus expenses. For those of you who have not started operating your business yet, you can generate a projected income statement for your first year of business. For those of you who are already in operation, depending on when you started, you may have the data to complete an income statement for the last 12 months. In order to create your income statement, make sure that you are in the Income Statement tab in the Excel spreadsheet. Start by identifying the period of time that the income statement covers. The first section of your income statement summarizes your revenue or projected revenue by identifying your total sales. So plug in your total sales for the period. Then you will identify your cost of goods sold or cost of service of those sales. Your revenue minus your cost of goods sold gives you your gross profit. Next is your expenses. Everything that you have identified throughout the business plan as an expense can now be included here. This might include operating expenses from your operations plan, IT services, marketing and advertising expenses, and insurance that applies for the specified period. Don't forget that you can change any of the expense titles if you need to. Your gross profit minus your expenses is referred to as EBIT, earnings before interest and taxes. Any interest you owe on loans and income taxes are included in the income statement and are also subtracted from your gross profit to allow you to arrive at your net income or net loss for that period. The statement of cash flow shows the amount of actual cash that is entering and leaving a company. The cash flow statement can show a company's cash on hand or shortage of cash over a period of time, indicating how well the company manages its cash and the degree of financial need the company has. The statement of cash flow is a very important financial statement for your business plan because it identifies whether you need to borrow money and when. In order to create your statement of cash flow, make sure that you are in the Statement of Cash Flow tab in the Excel spreadsheet. Start by identifying the period of time that your statement of cash flow covers in the Date section. The first step is identifying your opening cash balance. How much money in cash or in the bank do you have at the beginning of the period? Then, in the first month, identify how much cash you expect to collect. Remember that the cash flow statement is different from an income statement. Here, you only list items where you actually spend or receive cash. Sometimes, for example, if you offer customers credit terms, such as net 30, you might not actually receive cash until day 30. So in the cash inflows section, only include items where cash is received. Then, list all of your cash outflows for the month, identifying what you will actually spend money on. This can include expenses or purchases of things like equipment or supplies. These purchases and expenses should only be included if you are actually paying for them during that month. Some purchases can be made on credit, where the equipment is acquired immediately but cash is spent later on. You will notice that the spreadsheet will calculate the ending cash balance for you, which becomes the opening cash balance for the next month. Once you complete the first month, you will need to enter your cash inflows and outflows for the rest of the months on the spreadsheet in the yellow cells. Take a look at the ending cash balance at the bottom. If there are any months where you have a negative ending cash balance, it indicates that you will need to borrow money to cover your cash shortage.